We are moving too fast. 2 days back, silver was trading at $58. This morning, as I sit here recording this briefing, we just crossed 62.75. If you are a retail investor holding a few coins, you are probably cheering. You see green on the screen and you think, finally. But I need you to stop thinking like a retail investor for the next 20 minutes. I need you to think like a portfolio manager. I need you to think like a supply chain director at a solar manufacturing firm. Because if you look at this chart through their eyes, this speed shouldn't make you happy. It should make you sick to your stomach. A $2 move in a massive liquid commodity market in less than 24 hours isn't a rally. It isn't a bull market. It is a liquidity failure. It means the market is breaking. It means the mechanism that matches buyers and sellers has stopped working. Everyone in the financial media is blaming yesterday's Federal Reserve decision. You've seen the headlines. Fed cuts rates, silver soars. Powell blinks, commodities rally. That is the lazy answer. That is the answer for people who don't understand what is happening in the dark corners of the global warehouse network. Because while the Fed was busy blinking yesterday, China was busy locking the door. I've tracked 25 distinct market signals since the Fed announcement closed yesterday. I've looked at the shadow inventory in Shanghai. I've looked at the lease rates in London. I've read the fine print of the new Basel III liquidity requirements. And they all point to one terrifying reality. The global supply chain didn't just bend, it snapped. Why did Beijing wait until the exact moment the Fed cut rates to quietly enforce an export protocol that pulls 200 million ounces of physical metal off the table? This wasn't an investment opportunity. This was a trap. And at $63, the trap has officially sprung. This is the macro edit. Let's assess the damage. To understand why we hit $63 overnight, we have to look at the twin failures that happened yesterday, December 10th. Failure number 1, the Federal Reserve. The Fed blinked, despite Cleveland Fed President Beth Hammack effectively begging them to hold rates steady. Despite the dissent minutes showing the most split committee in 20 years, they cut rates. They looked at the bond market. They looked at the government debt interest payments, and they decided they had to save the Treasury market. But in doing so, they lost control of the commodity market. The moment that decision hit the tape yesterday afternoon, the algorithm changed. Institutional capital looked at the dollar, saw weakness, and fled into hard assets. That explains the move to $62. That is standard macroeconomics. Dollar down, gold and silver up. But it does not explain the move to $63. That extra dollar? That violent push higher that happened while New York was sleeping? That didn't come from a hedge fund algorithm. That came from Main Street panic. We are witnessing something we haven't seen since the late 1970s. We are seeing a run on the retail counter. Yesterday afternoon, reports started flooding in from Costco. As you know, Costco has been a major supplier of gold and silver bars to the average American consumer. It's been a fun novelty. But yesterday, it stopped being a novelty. We didn't just see limits tighten from 5 bars to 1. We saw something worse. We saw retroactive cancellations. Thousands of customers who placed orders, paid their money, and got a confirmation email. Woke up this morning to a refund notification. Costco isn't just rationing. They are discovering, in real time, that their inventory counts are wrong. They sold metal they thought they had, went to the vault, and found air. Meanwhile, the U.S. Mint, the official producer of American coinage, just suspended sales of silver eagles until January 2026. The official reason? Planche shortage. Let me translate that from bureaucrat speak. A planche is the blank silver disc they stamp the coin onto. If they have a planche shortage, it means they ran out of silver. When the United States government and America's largest retailer both run out of metal on the same week. You are not looking at a speculative bubble. You are looking at a bank run. Western traders woke up today expecting to buy the dip. They thought they could place an order at $62 and get filled. Instead, they found a vacuum. And this is where I need you to be my eyes and ears on the ground. I'm looking at the wholesale data, but I need the street data. Go to the comments right now. Tell me what you are seeing at your local coin shop. Are they out of stock? Are premiums spiking? Are there lines out the door? Leave a comment with your city and the status of your local dealer. I read every data point you submit. It helps us track the real physical squeeze faster than the Bloomberg terminal can report it. The shelves are empty, the warehouses are locked, and the price is discovering that reality in real time. The Fed cut rates into a supply shock. That is like throwing gasoline on a forest fire. And that is why we are at $63. Now, we need to go deeper. We need to look at the plumbing of the financial system, because this is where the real story is. Here are 28 distinct market signals synthesized into 3 specific vectors of failure. Vector 1 is the physical disconnect. If you look at your trading screen right now, you see the price of silver is $63. But if you call a dealer in London, or if you try to take delivery of a 1,000-ounce commercial bar, you are not paying $63. Industry reports from this morning show the LBMA spot price, the price for actual physical metal in London, is trading at a $3 premium over the COMEX futures price in New York. This is unheard of. In a normal, functioning market, that spread is a few pennies, maybe 10 cents. $3 is a statistical impossibility. This is unheard of. Arbitrage is supposed to fix this. In the old days, a bank like JP Morgan or HSBC would see this gap. They would see silver is expensive in London and cheap in New York. They would buy the cheap paper contract, sell the expensive physical metal, and pocket the difference. This arbitrage keeps the prices locked together. But they aren't doing it. Why? Why are the banks leaving free money on the table? It's not just because the vaults are empty, though they are. It's because of a regulation called Basel III. This is the boring regulatory change that nobody on YouTube talks about, but it is the reason the price is exploding. Under the new Basel III Net Stable Funding Ratio, NSFR rules, holding unallocated gold and silver has become toxic for a bank's balance sheet. In the past, banks could hold paper silver and count it as a Tier 1 asset. It was treated as good as cash. Now, regulators view unallocated silver as a risk. They require banks to hold massive amounts of capital against those positions. The Financial Times reported recently that London gold and silver clearing volumes have dropped to decade lows. Why? Because Tier 1 capital requirements have forced major bullion banks to exit the clearing market. They literally cannot afford to play the game anymore. So the paper fire hose, the massive volume of paper contracts that banks use to spray onto the market to cool down rallies, has been turned off. Not by the market, but by the regulators themselves. The banks have stepped away. The arbitrage machine is broken. And without that suppression mechanism, the price is free to seek its true level. And what is that true level? Look at the Shanghai Futures Exchange. Inventories have collapsed to just 531,000 kilograms. That is 17 million ounces. In a world that consumes 1 billion ounces a year, 17 million is zero. It is dust. It is less than 1 week of global demand. We recently tracked a massive anomaly in the data. 37.6 million ounces vanished from global vaults in just 47 days. It wasn't sold to ETF investors. It wasn't consumed by a sudden spike in jewelry demand. It was removed from the system entirely, taken out of the registered vaults and moved into private deep storage. This is the largest physical drain since 1980. And here is the signal that confirms the crisis. Backwardation, right now, in Shanghai. The spot price is trading higher than the futures price. This creates a condition called backwardation. It basically means the market is screaming, I don't care about a promise for silver next month. I don't trust you. I need the metal in my hand today. When the physical market decouples from the futures market, the price on your screen becomes irrelevant. The real price is, can you actually get it? And for the first time in 40 years, the answer for many buyers is no. Vector 2 is the industrial lock. This is why the $63 price tag doesn't matter to the biggest buyers. I see the comments. Who buys silver at an all-time high? Surely demand will collapse at these prices. I'll tell you who buys. A factory manager in Shenzhen who has a contract to deliver 10 million solar panels by June. He doesn't care if silver is $63 or $103. He cares about bankruptcy. In 2011, people bought silver because they were afraid of the dollar. That is discretionary demand. You can choose not to buy. Today, companies are buying silver because they are afraid of stopping production. Industrial demand is now over 60% of the market. And let's talk about the supply response myth. Wall Street analysts love to say, oh, don't worry. At $63, the miners will just produce more. Supply will catch up. No, they won't. Here is the geology lesson that Wall Street misses. 72% of the world's silver comes as a byproduct of lead, zinc, and copper mines. That means most silver is accidental. Miners don't dig for silver. They dig for copper to build houses and zinc to galvanize steel. They find the silver mixed in the dirt and they sell it as a bonus. This means the supply of silver is inelastic. If the global economy slows down and we need less lead for car batteries, the miners dig less lead. And if they dig less lead, we get less silver. It doesn't matter if silver goes to $500 an ounce. A zinc miner is not going to double his production just to get a tiny bit more silver byproduct. It's not worth it. So, supply is capped by geology. But demand is exploding. And it's not just solar, it's war. We are living in a kinetic world. Wars are returning to the headlines. Consider the Tomahawk cruise missile. Missiles don't fly without silver-zinc batteries. They need the incredible power density and reliability that only silver can provide. During peacetime, the military recycles old batteries. But during conflict, that silver is vaporized. It explodes. It is scattered into dust over the battlefield. It is gone forever. Every missile fired is 15 to 30 ounces of silver that is permanently deleted from the global stock. And then there is the solar mutation. We aren't just building more panels. We are building TOPCon panels. These new high-efficiency cells require 50 to 80% more silver paste than the old models. The industry hasn't just grown. It has mutated into a glutton. So, let's recap the math. We have the Fed cutting rates, stimulating the economy, creating more demand for electronics, right as the supply cliff hits. We have consumed 820 million ounces more than we mined since 2021. That gap was filled by draining the old vaults. But Vector 1 proved the vaults are empty. So, who sets the price now? The desperate industrial buyer sets the price. And a desperate buyer has no price sensitivity. They will pay anything to keep the factory open. Now we arrive at the kill shot. This is the piece of the puzzle that turns a shortage into a crisis. Vector 3, the geopolitical trap. While the Fed was cutting rates yesterday, China effectively nationalized its silver supply. They didn't call it a ban. That would be too loud. That would trigger a WTO lawsuit. They called it export control certification. Starting January 1st, 2026, less than 3 weeks from now, only state-certified enterprises can export silver. To qualify, you need an 80-ton annual production capacity. Most exporters don't have that. They are small processing firms, so they are out. And the ones who do have it, the big state-owned giants, they are subject to domestic priority mandates, meaning China eats first. If a Chinese solar factory needs silver, the exporter cannot ship it to London. It must stay in China. But here is the part the news isn't covering. Why is China hoarding? It's not just for solar panels. It's for the unit. Last month, Bloomberg confirmed the first trade settled between China and Brazil using a new gold-backed ledger system, bypassing the US dollar entirely. This is the BRICS trade settlement currency we have been hearing rumors about for years. But here is the key detail that mainstream media missed. When you reverse engineer the ledger, it implies they valued the gold at a 15% premium to the Western spot price. Do you understand what that means? China is telling the world, we will pay you more for real metal than London will. Bring your metal here. They are creating a gravitational black hole for physical precious metals. They are sucking the liquidity out of the West to back their new trade settlement system. This is the Hunt brothers playbook, reversed. The Hunt brothers tried to buy it all with debt. China is simply refusing to sell it and paying a premium to keep it using trade surpluses. They don't need to corner the market. They just need to control the exits. And the Fed, blinded by its own data, just walked right into the trap. They devalued the dollar at the exact moment China launched a superior bid for the world's real assets. So, what happens next? This is the part nobody wants to talk about. This is the part where I have to scare you a little bit, for your own good. On when the price goes vertical, the rules change. The skeptics will say, the exchange will never let the market break, they will fix it. And they are right, they will fix it. But fixing it doesn't mean paying you. Fixing it means saving the banks. We have a blueprint for this. Look back to March 2022, the LME nickel crisis. Nickel prices went vertical. They hit $100,000 a ton in a matter of hours. A Chinese tycoon nicknamed Big Shot was shorting the market, and he got caught. He owed billions. The banks that backed him were technically insolvent. So what did the London Metal Exchange do? Did they let the free market work? Did they let the Big Shot go bankrupt and pay the longs? No. The exchange simply turned off the computers. They halted trading. And then, they did something unthinkable. They canceled the trades. They looked at the investors who had bought nickel. Investors who played by the rules. Investors who had made millions of dollars on paper. And they said, no, those trades never happened. We are deleting them. They rewrote history to save the banks. This is the blueprint for silver. When the silver squeeze happens, when we blow past $100 and head for $200, do not expect the COMEX to play fair. They will declare force majeure. This is a legal clause buried in the fine print of every ETF and futures contract. It effectively says, if we cannot deliver the metal due to unforeseen circumstances, we have the right to settle your contract in cash. Imagine silver goes to $500. You feel rich. You look at your brokerage account and see huge numbers. But then, you get a letter. Sorry, we cannot deliver the silver. Here is your $63 back, plus a small premium. You get the cash, but the cash is worthless because the dollar is crashing. You miss the wealth transfer. This is why we have a golden rule at the macro edit. If you can't hold it, you don't own it. If you are holding paper silver, if you are holding an unallocated pool account, you are not holding silver. You are holding a credit claim against a bank that is short silver. When the music stops, you will not get a chair, and this is why you need to be subscribed to this channel. I am not here to entertain you. I am here to ring the bell at the top. We are entering the most volatile 18 months in financial history. The trap is set, but the exit is still open. If you aren't subscribed, you might miss the signal to get out. Click the notification bell so you see the alert when the ratio flips. So, how do we exit? Because we do want to exit eventually. Buying is easy, selling is hard. Most gold bugs make a fatal mistake. They fall in love with the metal, they bury it in the backyard and vow never to sell it. This is wrong. We are investors. We are here to grow our purchasing power. We need a signal. We need to know when the mania has peaked. That signal is the gold to silver ratio. This measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio sits around 80. But right now, with gold at $4,212 and silver at $63, the ratio has collapsed to 66 to 1. This is moving fast. Just a few months ago, it was 85. But we aren't there yet. In 2011, that ratio hit 30. In 1980, it hit 17. So here is the plan. This is the macro edit exit strategy. We hold our physical silver. We watch the price explode. We watch the headlines scream about shortages and force majeure. We ignore the dollar price. The dollar price is noise. We watch the ratio. When that ratio hits 40, we wake up. We start preparing. When the ratio hits 30, we execute the swap. We take our volatile, overvalued silver, and we trade it for gold. Think about the math. If you have 1,000 ounces of silver today, you can trade it for about 15 ounces of gold. If we wait, and the ratio drops to 30, those same 1,000 ounces will buy you 33 ounces of gold. You have doubled your gold holdings without spending a single extra dollar. You use the explosive volatility of silver to slingshot yourself into the permanent stability of gold. This is how the dynasties of Europe built their wealth. They didn't just hold. They traded the ratio. $63 is not the top. $63 is the alarm bell. The smart money isn't selling into this rally. They are holding for the ratio flip. They are watching the warehouses in Shanghai empty out. And they are watching the Fed print money into a supply vacuum. Market opens in 10 minutes. Stay sharp.